If the high of the first candle and the low of the third candle don't overlap with the middle candle, a gap is present. That zone, from the first candle's high to the third candle's low, is your fair value gap. Mark it with a rectangle, that's your zone of interest. Fair value gaps can form in both directions. Bullish fair value gap, created during sharp upward moves. Bearish fair value gap, forms during strong drops. If the first and third candles overlap with the middle candle, there's no valid fair value gap, no matter how large the middle candle is. There are 5 criteria for identifying a valid fair value gap as a liquidity key level. The first criterion is, the gap must be unmitigated. A valid fair value gap should be unmitigated. In other words, virgin. This means price has never returned to test or fill that zone. When the gap remains untouched, it suggests that unfilled institutional orders are still resting inside, making it a powerful liquidity magnet. Smart money often comes back to these zones to complete unfinished business. Once the gap is filled, the liquidity is consumed, and the zone loses its strength as a key level. The second criterion is the size of the fair value gap. Larger fair value gaps indicate a stronger imbalance, meaning more unfilled orders were left behind. The bigger the gap, the more significant the liquidity it holds. When multiple fair value gaps are present, focus on the ones with the largest size. They're more likely to attract price and deliver a reaction. Avoid fair value gaps near obvious support or resistance. If a fair value gap appears just below resistance or above support, be cautious. Those levels act as opposing liquidity pools. If price hits them first, it may reject sharply and invalidate the gap. A clean liquidity zone should stand on its own, not clash with nearby structures. Fair value gaps after break of structure are powerful. When price breaks a key level and immediately forms a fair value gap, that zone often marks where smart money re-enters. These gaps are filled with unexecuted orders left behind by the aggressive move. The first retest of this type of fair value gap often leads to a strong reversal or continuation. It's one of the most reliable liquidity-based setups. Wait for confirmation from price action. The presence of a fair value gap doesn't guarantee a reversal. It simply marks a potential liquidity zone. To validate it, wait for a clear reaction, such as a strong rejection candle or a reversal pattern. If price reaches the gap and shows no sign of rejection, avoid the trade. Smart money reacts with intent. So should we. Now let's look at a chart example. This is the US dollar JPY daily chart, and as you can see, the market is in a clear uptrend. Here we have a textbook fair value gap. This is the first candle, the second candle shows a strong bullish move, and the third candle's low doesn't overlap with the high of the first, creating a visible price gap. This gap qualifies as a valid imbalanced liquidity zone because it's unmitigated, price has never returned to it, it's large, indicating a strong imbalance, and it's located away from major resistance, which avoids conflicting liquidity. But is that enough to enter a trade? Not yet. We still need the market to retrace into the gap and show a clear reaction, such as a strong rejection candle. If price touches the fair value gap but shows no reaction, the setup is weak and should be ignored. Now look what happened. Price came back, tapped the fair value gap and printed a clear bullish pin bar, a strong sign of rejection. From there, the market continued upward with momentum. Here's another example, this time on the US dollar Canadian dollar 15-minute chart. The market is clearly trending downward and has just formed a fair value gap. Let's check if this gap is valid. The low of the first candle and the high of the third candle don't overlap with the strong middle candle, so the gap meets the structural criteria. The gap is unmitigated. Price hasn't returned to test it yet. While the size isn't large, it's acceptable and still shows imbalance. But that's not enough. As always, we need confirmation. We wait for price to retrace into the fair value gap and watch for a strong rejection. Now look at what happened. Price retraced, tapped the gap and immediately rejected it, then continued dropping. This rejection signals that the market respected the imbalanced liquidity zone and that unfilled sell orders were likely executed there. Now let me ask you an important question. What if you find both a supply zone and a fair value gap at the same time? Which one should you trade? Let's break it down with examples. In this first example, we have a clear supply zone. It meets all the criteria of a high probability liquidity zone. Strong candle momentum, fresh zone, break of structure. But right below it, there's also a fair value gap. So which one do we focus on? In this case, the answer is simple. We prioritize the supply zone and ignore the fair value gap. Why? Because the supply zone represents a true area of institutional selling, where smart money likely place large orders. It has stronger structure, more confluence, and holds deeper liquidity than the fair value gap in this context. Let's look at another example. This time we have a strong demand zone, and just above it there's a fair value gap. Same principle applies. We ignore the fair value gap and focus on the demand zone. Fair value gaps are important, but when a clean, high-quality supply or demand zone is present in the same region, it takes priority. Think of fair value gaps as secondary liquidity zones. They're valid, but only when they're not competing with a stronger structure like a supply or demand zone that meets all three filters. So always ask yourself, which zone has more evidence of smart money activity? If the supply or demand zone checks all the boxes, that's where you want to focus your trade. Now you know how smart money targets liquidity and how to spot the zones that actually matter.